with us, thankfully, and to talk about this news and a lot of others as well. Ajay, good having you. Thanks for joining in. Before we talk about the markets at large, I believe you heard our chat with S. Subramania of Titan. What's your view on this news? Does it materially impact any of the jewelry companies?
I think, as Mr. Subramania mentioned, the main advantages that these companies would have is that the balance sheets, I think, would see a significant improvement. Their cost of gold would come down substantially, and I think that would sort of aid the bottom line performance of these companies. Also, I think from the macro perspective, I think a large amount of illicit smuggling of gold was happening because of this 80-20 rule, as well as the procedural hassles that these companies were facing in terms of importing gold. Now that sort of will clearly be a thing of the past, and the government's revenues also could see a bump up due to the 10% customs duty that's there on the legit imports of gold. So I think overall the government has taken a very positive step in terms of scrapping this 80-20 rule, which will be very positive for the sector as a whole.
What about the crude cool-off, Ajay? That seems to really be propping up names like NHP, BP. What is the take now on how the crude lowering is going to aid A, the OMC basket, and B, of course, that really pins pressure on the RBI governor to actually move tomorrow?
Yeah, I think every $1 drop in per barrel in crude prices leads to roughly $70 million or 4,000 crores of savings of under recoveries for the country, 60% of which, roughly 2,400 crores, accrues to the government. That is, the government's fiscal deficit comes down by that much amount, and 40% roughly is the lower burden that goes on the upstream companies like ONGC, GAIL and OIL. We have seen roughly $40 per barrel drop in oil prices from June, from 115 to around below 70 now in Brent prices. So I think that essentially is extremely positive from macro perspective. Every $10 drop in crude prices leads to, as per our calculations, roughly 0.1% drop in the inflation, in the wholesale price inflation, and an increase of 0.1% in GDP, as well as a reduction of roughly around 0.1% in the fiscal deficit. Let's not forget that oil imports constituted nearly 40% of country's total imports. Last year we imported roughly 190 million tons of crude, $143 billion worth of crude, in nearly 80% of our requirements. So I think from a macro perspective, the sharp plunge in oil prices, I think is extremely positive for the government to put its house in order. And we have seen that the fiscal deficit numbers for the first 7 months have been extremely worrisome, with the fiscal deficit at 89.6% of the budgeted estimates, vis-a-vis 84.4% in the same period last year. But what is more important, Ayesha, is to concentrate on the quality of fiscal consolidation. The revenue deficit numbers for the first 7 months, if you look at those numbers, then you see that the revenue deficit in the first 7 months is nearly 98.5% of the budget estimates versus 92.9% in the same period last year. And the primary deficit, which is the fiscal deficit minus the interest payments, which is how efficiently the government manages the finances, in the first 7 months is at 259% of the budget estimates versus 159% in the first 7 months of last financial year. So I think the government needs to get the divestment going. Out of 58,000 crores worth of total budget estimates, the government has not done anything. We also need to see a far significant cuts in the non-plan expenditure. The government has announced 10% cut in non-plan expenditure. It needs to ensure that, unlike the previous regime, when the plan expenditure was cut by 80,000 crores last year and 1 lakh crores in FY13, and that's how Chidambaram achieved the fiscal deficit, this government needs to refrain from doing it. Because if you cut plan expenditure with such large amounts, it has an impact in terms of the revival of investment cycle. So I think the RBI will be well advised to tread very cautiously and not give in to the clamor from various quarters to prematurely give in to the fight for inflation is concerned. Watch how the government performs in its budget insofar as quality of fiscal consolidation is concerned, and also see how the base effect plays out in January, February and March in terms of inflation. And then sometime in the end of the current financial year, take a stance of whether they want to lower the interest rates.
Okay, Ajay, stay on. So much more to speak to you about. Take a very quick break. We're discussing crude beneficiaries, and we'll continue doing that on the other side of this quick break. Stay tuned.
Well, there are going to be other beneficiaries also with the crude cool-off that we've seen. Ajay, now we've chatted about the OMC basket, but what about the FMCG pack? Because raw material prices also come down for them, and Asian Paints is a key case in point.
I think, as you mentioned, titanium dioxide and other crude derivatives form a large portion of the total raw materials for the paint companies. So I think the pack in general will be a large beneficiary of the falling crude prices.
Okay, Ajay, so I'm guessing you're saying that you would be bullish on these stocks from a medium-term perspective, the FMCG names.
Yes, I would tend to agree with you.
Okay, great. Ajay Bodke, I understand we have to let you go at this note, but thank you so much for joining in today and giving us that perspective. Really good having you on air today.
Thank you.
That's the view from Prabhudas Lilladher, Ajay Bodke. He's bullish on the FMCG names, the pocket at large, and of course, he's given his view on the OMCs as well. But moving away from oil and gas on to some of the small cap names as well. And Nikunj, actually not small cap really, but